Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scaper.
Robert Scaper here for Making Your Miles Count podcast, and today we're going to talk a little bit about taxes. Everybody's just gone through the income tax season. Some people have got a refund, some people got to pay a lot of money. Independent operators, generally speaking, have to pay, but this isn't the type of or the season of the year to actually pay. They generally pay beginning of January or so, and oftentimes get an income tax refund in April. So a lot of people ask, how do you actually save taxes and the like? Bottom line is it's actually not the accountant that saves taxes. It's the system that they use to calculate your taxes that saves you taxes. Now, the best way to do that, to illustrate this, is to use an example. I'm going to use an example of a dumb car and a smart car. Now, a smart car actually has within it that category a car that's called a smart car, because a smart car I'm going to call anything that costs relatively low in the operation of the vehicle. Whereas a dumb car is something that costs quite a bit per kilometer to operate. It's easy to see a dumb car. You take a look at a $50,000, $60,000, $80,000 SUV or an F-250 diesel. It's a high cost, high experience oriented vehicle. Now, when you're talking $50,000, $60,000, $80,000 worth of an SUV, generally speaking, you're getting 12, 15, 17 miles to the gallon. And the like. It costs an awful lot to operate a vehicle like that, and that's really important in the argument of how do you save taxes and how do you not. There's a lot of individuals who say, you know what, you take an expensive vehicle and you put it into your corporation, and voila, suddenly now you get this benefit from of a really nice vehicle for as a tax deduction. That is an extremely very naive, very short-sighted view of dealing with your taxes. Let me give you an illustration. When it comes to a tax deduction, the best you can possibly ever get from a dumb car is 100% of the costs expensed. Think through that sentence for just a second, and the implication is there's something that you can actually get more than 100% of the costs actually expensed. And you can, and if you wait around for just a few minutes, I'm going to explain how you can do that. But let's use, for instance, your F-250 or 50,000, 70,000, 80,000 SUV, and you put that into a corporation. If somebody does that, I usually call that an extremely bad business move. But let's say if somebody does do that, they're putting all of the fuel, the maintenance, the lease, the depreciation, the interest, everything is put into the corporation as a cost for operating that vehicle, which is true. Now, if you're getting 15 miles to the gallon, your fuel expense is very high. If your vehicle cost is $80,000, the depreciation on there is $5,000, $7,000, $8,000 or more per year. So it's extremely high cost of operating that vehicle. And the justification in the mind of an individual to put it into their corporation as well, it's a high cost, but it's all tax deductible and that's okay. That is actually an extremely short-sighted, very narrow view of, first of all, operating a business, and second of all, dealing with taxes. It's a terrible position to have. It's one that salesmen for SUVs and very high-priced vehicles, they say all the time, oh man, you got a corporation, throw it into there, it's 100% tax write-off. Actually, they say a lease expense. If you got a SUV with a lease, that's even better. You can write the whole thing off. Well, right there, you're taking tax advice from the salesperson who's selling you a vehicle. bad advice. Never take tax advice from a salesperson who is getting commission on the sale or the lease of the vehicle you're considering. It is, first of all, it's horribly wrong, because you can write off 100% on the condition that every single kilometer of that vehicle is proven to be for business use. If you use 1% of that vehicle for personal, it's not, first of all, it's not 100% write off. Now you got 1% of the cost of that vehicle that you have to pay back to your corporation for the operation of that vehicle. And sometimes that gets extremely expensive. It is much more tax onerous than any type of tax benefit that you can get. If you are of the type of a personality who says, oh, I can save it because I'm going to save taxes from it. Realistically, you're not a numbers person. You're actually getting a lot of emotions involved in the decision of a vehicle like that. And when you get emotions of it and you say, hey, you know what, I'm looking like a big man on campus and nice chrome wheels and the whole thing, very, very expensive. That is not business minded, because realistically there's some sort of a pride issue or something like that in there, and it should not be a part of your business model. It's skewed. I mean, if you do it, at least you know that it's not a smart business move. It is, in fact, a very expensive personal and business move for that. But if you put your entire vehicle into your corporation and you have $15,000 worth of expenses for that vehicle, you still need a logbook. You absolutely need a logbook in order to differentiate between what is personal and what is business. Did you know that 80% of all owner-operators out there do not have a logbook that differentiates between the business and the personal of the vehicle they have in their corporation? And do you know what auditors call that? They call it low-hanging fruit, an easy way to reverse everything out of there. So everything that you've expensed and thought, hey, I'm getting a great deal on this because I can expense and bring my taxes down, the entire thing is reversed and you don't get to write off anything of it. That's what they can legally do if you do not have a log. You're placing yourself in a huge risk when you do that. But let's just say you do have a log and you say 25% is personal, 75% is business. First of all, if it's 75% business, 25% personal, the 25% of that $15,000, now you have to pay your corporation back for using that vehicle. And it's an extremely expensive move from your perspective. So that is something that I highly advise against doing when you're an owner-operator and have your own corporation. So that's the first thing. The second thing has to do with just the concept of 100% of costs. Let's say, for instance, just miraculously you're able to get 100% of the costs associated. It's really high costs. And what is your purpose in life? Is it to reduce taxes, or is it to build after-tax wealth? When you are putting a huge expense like that through your corporation, the end result is you're trying to lower taxes and you're not trying to build after-tax wealth. That is the problem. So you're losing money for the sake of taxes. For that matter, it is a very, very foolish perspective to have in your business. What you want to do is to be able to pull money out, what's called non-taxable benefits or tax-free, and or somehow or other get wealth out of your corporation with minimal taxes. And I will show you how to do that. So if you have a dumb car and you put it into there, the most you will ever get is 100% of the cost expensed for your corporation. But there is another way of utilizing vehicle travel costs, and that's what I call a smart car, or something. Not the smart car, but anything that produces a lower cost per kilometer. Very different. Like you buy a smart car. you can buy like I have a Jetta diesel, for instance, that the fuel just by itself at a $1.50, $1.60 a liter, I'm looking at 10-12 cents per kilometer for the use of that vehicle. It's a very low cost per kilometer in there. And the vehicle itself, when I purchased it, almost brand new, I've never bought a brand new vehicle, but I paid 19 grand for it. And I've had it for 7 years, and I've had it for 7 years, 19 grand. It's worth maybe, I don't know, 5 or 6 now. I had it started out with 36,000 kilometers on it, and now I have 360,000 kilometers, worth maybe $6,000 for a diesel. Still got another 140,000 kilometers on that vehicle easily. So that's why it's worth that much. So depreciation on that vehicle over 7 years, you're looking, $2,000 per year, a minimum. That's approximately what the depreciation on that vehicle is, as opposed to an SUV that depreciates $10,000 a year. $2,000 a year for depreciation on a vehicle, that's an acceptable amount. I try and make it a little bit more like $1,500, but then I have to deal with a little bit more used vehicles. My wife and I, we actually have 3 vehicles. You buy at a very good price, and the actual depreciation actually is a very nominal amount. I have a friend who goes out and he buys a $500 vehicle, puts about $600 or $700 into it for repairs, license it, he drives it for 2-3 years, and then he sells it for $2,000. Now he actually makes money on that, but that is a rarity. Very few people actually do it, and they're working with much older pieces of equipment and stuff like that. If a person can do it, that's fine. I've never been able to make any transactional income from automobiles. That's just not my thing. I'm not even looking to apply myself to do that kind of thing. But when it comes to keeping your costs down, also insurance. Insurance, we don't talk very much about it. You have an $80,000 SUV or an F-250, you're paying thousands and thousands of dollars per year, probably $2,000-$3,000 a year to insure something like that, as opposed to maybe $1,500, $1,800, $1,700 for a smaller, less expensive car. So you have to consider all of the costs involved in a vehicle in order to determine whether it's a smart car or whether it's a dumb car. So now you have a smart car, and that your cost per kilometer generally operates between my actual operation cost is somewhere between 22, 25, 28 cents per kilometer. I can actually make money with my car. I'll tell you how. Instead of having my vehicle inside my corporation, I actually keep it all personal, and I invoice my corporation whatever, 50, 55 cents a kilometer for the use of my personal vehicle. And if my operating costs are 25, let's say 30 cents a kilometer, and I'm getting 50 cents a kilometer for it, that means I'm expensing 50 cents a kilometer while my costs are only 30. That extra 20 cents a kilometer is actually my money, tax-free, and it's expensed through the corporation. An extreme example of this, and it's my example because I use my Jetta diesel on it, I charge 50 cents a kilometer for the use of my vehicle. My costs, like I said, was 25, 30. I bought it with 36,000, like I said, and now I have about 360 in it. At least 300,000 of that has been from the use of the business. That means that vehicle over a 7-year period has actually paid for itself 3 times, and it's paid me in after-tax money. And realistically, when you are looking at your corporation, the first thing you don't want to do is put a vehicle into your corporation, because then you're automatically capped and limited by the amount of remuneration that you can, or benefit that you can get from that vehicle. So what you want to do is you get a smart car or a lower cost vehicle, and then have the corporation pay you at a rate that is higher than the costs of your vehicle. And it's actually quite easy to do, because a lot of vehicles have reasonable rates of cost in it. The more actually you use it for your business, the better off it is, because some of your fixed costs, like your insurance or your potentially your depreciation, is actually it's lowered the more you use the vehicle for your business. So I encourage you to use your personal vehicle as much as you reasonably can for your corporation. And whether it's 4, 5, 600 plus kilometers per month, that's a reasonable amount for moving around people and equipment and stuff like this for your business. Some do more than that. If they have multiple trucks, if they have multiple employees, some do much more than that. And I always recommend keep the vehicle personal, in their personal name, and bill out on a per kilometer basis. Now, there is some rule restrictions on that, and that is if you have one vehicle that uses more than 5,000 kilometers in a year, the rate does go down. But the software that we use in our programs automatically calculates that, so you don't have to worry about it. But realistically, that is by far the best system to operate. It's also great when it comes to factoring in for your taxable income and for your reducing the costs of your taxes in a year. If your actual costs are 30 cents, like mine is, and your remuneration is 50 cents, you actually are getting 167% of your costs. You're actually able to expense through your corporation. It is a great system, but remember, this is a system, and the system should be explained to you by your accountant. The accountant will only use whatever it is system that you decide. If you come in there and you say, I bought this new SUV, put it into my corporation, generally speaking, he's not going to say, well, you shouldn't do that, you do something else. He doesn't, maybe if he does, good for him, but realistically what he should be doing is saying, wait a minute, before you do that, what you really need to do is be paid cents per kilometer, because it's the system that saves you money, and it is not the accountant that saves you money. Now, when it comes to meal expenses, there is another system. There's two different systems out there. There's the TL2 simplified method, which 99% of all accountants use, and then there's non-taxable benefits system, which basically only maybe 1% of the accountants in Canada use non-taxable benefits. And the first thing we should show you is the TL2 simplified system, well, I call the dumb system, and then there is the smart system, which is non-taxable benefits. The TL2 simplified system, everybody understands it basically as the $69 per day that you get. Now, per day is per diem, they call it. Per diem is just Latin for per day, and so they use the same terminology in the TL2 simplified system as they do in the non-taxable benefit system. Non-taxable benefit talks about a per diem that you get, and realistically, they use the same terminology, but realistically, it's completely different systems, and makes a huge difference in taxes. Let's take a look at the red and blue charts, and got from 1984 to 2024. That's 40 years of information regarding the TL2 simplified method. Now, in 1984, I also started getting information from the non-taxable benefit system, and in order for me to get the consistent numbers on that back to 1984, I had to go through a request, a Freedom of Information request, because to my understanding, there's no place in Canada that actually has the comparison history of the TL2 simplified method and the non-taxable benefit looking side by side. If you look at this, the red lines over the 40 years is the TL2 simplified method, which is what I call the dumb system. And the blue lines are actually the non-taxable benefit system. Now, there's quite a few things to realize. First of all, not only is the blue much higher than the red, but some people say, well, $69 a day, that only looks like it's just under $20 per day. That's correct, because the after-tax benefit of $69 is approximately $17.04 per day. And now it varies quite a bit between different provinces. Some provinces as low as $9.44, another one's $20.80. So it depends very much on where you live in Canada, what that $69 actually represents to you in what they call non-refundable tax credits. Okay, so but it's approximately $17.04. I can do a complete history of the red line. It looks like it's pretty much straight, but actually from 1984 forward, it actually goes down a little bit, then it goes up again, and then it goes up sort of gradual over a few years, and then it bumps up every now and then. The effect that it has on whether it goes up or down has nothing to do with anything other than politics and public opinion. For instance, Paul Martin at one point said some people are not paying their fair share of taxes, and so he reduced the tax deductibility of your meal allowance from 80% down to 50%. And then it was a number of years of yelling and screaming and all sorts of complaining by the trucking industry. And then Stephen Harper came into power, and he moved it from 50% back up to 80% over a number of years. Now, that being said, there was also some other numbers that came up and down, but that had to do primarily because there was political pressure at the time to change those numbers. So anyway, though, if ever you see any kind of movement on that red line, it has to do with public opinions and politics. For instance, the moving from $51 per day to the $69 per day, that had to do with during COVID, when truck drivers said, you're frontline and thank you very much, and so we're going to give you a raise. So they actually retroactively, halfway through 2020, said for the entire taxation year of 2020, we're going to bump you up from 51 to 69. Now that's $69 when it's reduced down to $17.04. That's actually what occurs on your personal income tax return, and we have to consider that when we are comparing it to the blue line, which is the non-taxable benefits. That makes a huge difference because blue line is paid to you in non-taxable benefits or after-tax money, whereas so you have to compare after-tax to after-tax, and that's why the huge change in there is. And the reason why non-taxable benefits make such a huge difference in the trucking industry is because drivers are, especially the long distance drivers, are on the road 240, 250 days per year. And when you're in travel status that long, you can collect either non-taxable benefits or the TL2 simplified method, which multiplies that $17 per day. But non-taxable benefits make such a huge difference when you are gone that long in that many days in a year, and you compare it to such a small number like $17 per day. So when it comes to explaining non-taxable benefits, this is where an employer-employee agreement comes in. In my first book, when I talk about per diem, or back then I called it a subsistence allowance, which is another word for the non-taxable benefits, you have to have an employer-employee agreement. Best explained this way. You do understand with non-taxable benefits when it comes to, let's say you are my employee and I asked you to use your personal vehicle, and I would give you 50 cents a kilometer for the use of your vehicle. You go out, do 100 kilometers, I write you out a check for $50. That's a non-taxable benefit. That was the first example of non-taxable benefit. But there's other things that you use non-taxable benefits for as well, and that's for meals. Let's say I asked you, you're my employee, and I asked you to go to a far City, work there for 3 days. How are we going to deal with your meal expenses? Well, you can keep all meal receipts for the entire 3 days, just give them to me in an envelope. I total it all up, and that's an actual reimbursement for business or work-related costs. It's an actual expenses. Non-taxable benefits are always estimated. They're estimated reimbursement for job-related costs. Estimated when it comes to cents per kilometer for the use of your vehicle at 55 cents per kilometer. That's an estimate at 55, but it has to do with an employer-employee agreement. The same thing I can do when I send you out for 3 days, and I can say, I'll give you $100 per day. It's an estimate. I'll give you $100 per day. You come back. 3 days, I write you out a check for $300. And it is classified by Canada Revenue Agency as a non-taxable benefit. Well, the system works absolutely fabulous, especially if you can tie your employer-employee agreement to your non-taxable benefit, which not just for your cents per kilometer for your personal vehicle, but also now for your meals. We tie it to the Treasury Board of Canada, National Joint Council, and please ignore my phone. But anyway, we tie it to the Treasury Board of Canada, and instead of waiting around for public opinions and politics to change the amount of remuneration for your non-taxable benefits, when you tie it to the Treasury Board of Canada, you get raises twice per year. That means on April 1st of every year and October 1st of every year, you actually get a raise. It ranges anywhere from 35 cents a day all the way to $2 or $3 per day that you get a raise. That makes a significant difference in your tax-free money that you receive. If you take a look at this chart, this red and blue chart, and you realize that it's getting further and further apart, you realize that how can a system or the two systems, they're actually moving in different directions, which is true. When I wrote my first book, Taxes, the amount of tax savings that you got from non-taxable benefits was about $7,660 per year. Today, you actually get $12,500. That's our firm's client average. Well, you're saving more today than you were like 15 years ago. How can that work? And that's because the two systems that I explained, they're actually the numbers are spreading further and further apart. And that's why you want to choose the right system to save you taxes. And realistically, again, it's not the accountant that saves you money, it's the system that you use. So as you can see, non-taxable benefits or the TL2 or non-taxable benefits and putting your vehicle into your a corporation, those two systems, the non-taxable versus whatever else is utilized, is an extremely great comparison between two extreme systems, one that costs you an awful lot and the other one that saves you an awful lot of after-tax wealth. So there are actually 7 disadvantages of using non-taxable benefits. I'll go through them very quickly. Number 1, it's complex. It's a little bit intimidating right at the beginning to realize, okay, now you got to go through the incorporation process and you have to start paying yourself differently through your corporation, and everybody has to be trained. And it's not insurmountable at all. Everybody can be trained. If you can learn how to use your logbook for long distance trucking, by all means, you can learn non-taxable benefits. It's a absolute fraction, 5% of the amount of knowledge that you have to learn to utilize non-taxable benefits versus a logbook for a highway tractor. So it is complex, but it is definitely learnable. Second thing is it is costly. And by costly being that if you compare the self-employed method versus the corporation using non-taxable benefits, it is between 2 and 2.5 times more work for an accountant to complete a non-taxable benefit return than it does the self-employed method. Now, additionally, you also have to go through the incorporation process, which is anywhere from $500 to $1,500, depends whether you do it yourself or go through a lawyer. So there is an increased cost to the operation of a non-taxable benefits system, but the ROI, the return on your investment, is exceptional. It is 6 times what it costs you. So if it costs you an extra $1,000, you're getting back way more than $6,000. So it's if your additional cost is $1,500, it's a good 7 or 8 times what you're getting back in tax savings than it is what it's costing you to complete the additional returns from an accountant's perspectives. Okay, the third disadvantage is monies in trust versus amount owing. That is a very unusual disadvantage, because when you are self-employed, at the end of the year, the accountant calculates the amount owing to Canada Revenue Agency, and it's just that, an amount owing. So you can start making payments on it. Generally, they divide it up into 12 equal payments, and it takes you a year to pay off your last year's personal income tax. Now, actually, in my research, approximately 40% of all owner-operators out there who utilize self-employed make payments on their last year's income tax. First of all, because they had no idea what they were doing, and very few people actually save up for it. So they utilize this amount owing to Canada Revenue Agency as just another debt to do it and make payments down on it. When you utilize the non-taxable benefit system, you separate your personal income from your corporate income and your business income, and your business actually now has to remit taxes on your behalf. And so, in other words, it transfers the responsibility from you yourself personally to your own corporation. And at face value, it says, well, so what? Isn't it still an amount owing? And that is wrong. And that it is now monies in trust. Now, monies in trust is probably one of the most widely protected forms of finances that is in the free world. It is protected by law. People go to jail like a lawyer will go to jail if they take money out of the funds that are in a trust account. And the same thing can actually happen when directors, or you as a manager of even your own corporation, if you start spending money and then suddenly don't have money to send into the source deductions. And that monies in trust makes a huge difference in how you manage your cash. Now, if you're the kind of person who always has your reserves, so you always pay your bills 100% when they occur, then it's actually no problem at all, because you have the money, you pay for it, and it's basically due on the 15th of the month following. So, but you can't make payments on monies in trust. It is immediately due when it is due, and that's where a little bit of a problem comes in for individuals who have difficulty managing cash, so that, well, maybe I don't have cash to pay for the source deductions this month. I'll make double payment next time. You are violating the monies in trust rules, and it can come back in a big way to penalties, interest, money seized by Canada Revenue Agency. It's not a good thing. So you have to think differently. A lot of good operators, it doesn't even make any difference to them, because they always have the money set aside for taxes. So it's very, very individualistic whether they have the money or not. Now, the fourth disadvantage of using non-taxable benefit is insurance disability. If the average truck driver is making $65,000 of taxable income and paying taxes between $12,000 and $18,000 a year when they're not using non-taxable benefits, and then all of a sudden they're using non-taxable benefits, instead of reporting $65,000, now suddenly they're only reporting $25,000, $30,000 in taxable income, and they only pay taxes between $2,000 and $8,000 a year. Now, the first thing that happens is when it comes time to be disabled, or when you're disabled, you break a leg. Well, whether it's workers' compensation, WSIB, whatever it is, whatever insurance disability you have, the first thing the disability looks at is, okay, what did you make last year? And they take a look at your T1 personal income tax return. And you're not reporting 60-65 anymore. Now you're only reporting 25-30, and my goodness, you are your benefits from your insurance is basically cut in half. And so that is something that you have to very seriously consider, and you have to buy a very unique type of insurance, disability, to cover the deficiency, because whether it's workers' compensation, safety, whatever it is, or whether it's sometimes even a disability clause or a disability plan that you're paying for, 95% of the disability plans actually they refer to your T1 in your personal income tax return, and they ignore the non-taxable benefits, which could be $30,000, sometimes $40,000 per year. And it's something you should be considering. The fifth disability is Canada Pension Plan contributions. And this is a little bit funny to debate, because first of all, I've had debates with guys saying that Canada Pension Plan is really not a pension plan, it's actually a tax, and you don't get any benefit. Personally, I don't agree with that. There is a benefit to it. It's a very low benefit. It's not a very good return on your investment, but there is a benefit to it. And if you don't contribute to it, if you under-contribute it, if you're going $65,000 in taxable income, not using non-taxable benefits, you're contributing pretty much the maximum amount of your CPP, both the employer and the employee portion. But if you suddenly are now using non-taxable benefits, which saves you, $1,000 plus a month in taxes, you are not actually contributing the maximum amount of the CPP anymore. It's almost half of what you would otherwise have been paying. And so that means a portion of that $12,500 is actually Canada Pension Plan contributions. So you have to remember that. So in your tax savings, you should now consider to be put more and more towards whether it's RRSPs, TFSAs, some sort of instrument that is going to assist you in your retirement years. And you should be remembering that. Now, the sixth disadvantage of using non-taxable benefits has to do with loans at the bank. When you're very young, everybody says credit rating, and which is absolutely correct. When you have very, very little to start off with, like pretty much we all did, realistically, you need a credit rating, and one of the things that affects the loaning at a bank has to do with how much you actually make. If you were historically making $60,000-$65,000, now suddenly you're making $25,000-$30,000. Oh my goodness, the loans officer can have a minor cardiac and hand out some tissue and start crying for you because you're not making nearly as much. But what he's not calculating back into the formula is your $30,000 to $40,000 of non-taxable benefits. Now, depending in terms of which bank account or which financial institution that you're using, sometimes they add it back in and sometimes they don't. And sometimes it's no more a factor of the loans officer, which is nothing more than a glorified teller. They just click and send it out to Toronto, and Toronto says, hey, we're not adding this back in, and you don't get anything. So when you're young, when you're young and you don't have a house or anything like that, it can be an issue using non-taxable benefits. There are some institutions like Case Populaire and credit unions which add it back into the formula, and then it makes no difference, and so it's fine. But it's very, very dependent on the institutions that you utilize to get a loan at the bank. So the seventh disadvantage is a very significant one, and it is the liability to defend to Canada Revenue Agency, the non-taxable benefit filing. Now, this is something that we've been using non-taxable benefits for over 20 years, and every single year we have to defend the system to Canada Revenue Agency. We're extremely proficient at it, but it has changed considerably as well. For instance, if I look back 8 or 9 years ago, how we defended we defended non-taxable benefits to Canada Revenue Agency, I'm a little bit ashamed, because what we used 8 years ago would not be able to actually be used today. The defense of non-taxable benefits has actually increased in its complexity, and that is why, in my opinion, people should never use non-taxable benefits, especially in the trucking industry, to save you $12,000 a year, unless you have a very significant technological application in the utilization of non-taxable benefits. In everything from the ELD all the way down through to your personal income tax return. That's pretty much it needs it. Personal income tax return, that's past the minute book for your corporation. There's a whole bunch of complexity in the defense of non-taxable benefits to Canada Revenue Agency. We do probably about a half a dozen defenses every year, and even utilizing it with the technology that we have, there are some times that we even have been pushed right to the edge and almost had to go through courts for it. And there's two primary factors that Canada Revenue Agency looks at when it comes to whether they're going to push an accounting firm or a taxpayer to defend the non-taxable benefits. The first has to do with the complexity and the application of the non-taxable benefits itself. For instance, if you are in Ontario on October 18th, does your logbook verify the non-taxable benefits that you're claiming on that day? So the intricacy from the ELD through the filing of the non-taxable benefits on that particular day and every individual day that you're collecting non-taxable benefits, is it seamless all the way through down to the minute book of your corporation? That's the complexity that they are looking at. If it's just scribbled on some sheets of paper and plugged through some spreadsheet or something like that, an eyebrow will go up, and the probability of passing that audit is going to be lower. Now, the second factor, and this is, I actually view this as not being very fair, but the second factor that Canada Revenue Agency looks at is this going to go to court? If you are a basement bookkeeper, or you just you got half a dozen or so clients and that want to use non-taxable benefits, I can pretty much guarantee you Canada Revenue Agency will look at your firm and say, are you going to go to court? Well, that's the first question. The second question maybe is, who's going to pay for the court appearance that is going to be defending you to Canada Revenue Agency? If your existing accountant says, well, yeah, I'll defend it, is that defending it to what? Just an argument over the phone? Or is that actually going to court? You will pretty much, if you ask that blunt question, are you going to take this to court and pay for the costs of defending non-taxable benefits on behalf of you filing it for me? Are you going to absorb the cost of going to court for that? And they say they will more than likely. I don't see any firm saying yes, we'll absorb that cost, because it'll cost somewhere very low, between $5,000 or $6,000 to $10,000 to go to court with Canada Revenue Agency on defending something that generally would take about $10,000-$12,000 in per tax savings per year. They generally would look at 2 years, so you have about $25,000 worth of taxes, and going to court, and it's going to cost you $5,000 to $10,000. Is your firm going to actually defend that and under their cost, or are they going to bill you separately for that extra $5,000 or $10,000? That is something for you to consider. If they're going to guarantee the filing of it and they're going to go all the way in defending it, that's something for you to consider when choosing an accountant to defend this and prepare it to Canada Revenue Agency for that. But the liability issues is very, very real, and it is not a static. It is dynamic. It's getting more and more difficult to comply to the system, and realistically, you need technology in order to do it. It's very, very labor intensive to do it. I know, because we used to do it with little spreadsheets and little sheets of paper, 15 years ago, and it takes considerable more time to complete your returns using non-taxable benefits. So those are the 7 disadvantages of using non-taxable benefits, and there's one more topic I'd like to do, and that is, why doesn't accountants use non-taxable benefits? I wrote first on non-taxable benefits in 2008, was when my first book was published, and since then I've talked to accountants all across Canada, and I've been amazed at, number one, first of all, it takes about 3 or 4 minutes, and I can and I can explain it to them, and the light goes on. They understand what's going on, and I have yet to find a single accountant that I've talked to, and I've talked to, 60, 70 of them across Canada over the last 15 years. I've yet to talk to one who says, yes, I'll do it. Because when I ask them, and I says, hey, you understand? Yep. Are you going to use it? No. Because number one, the liability issues is so high, and the remuneration from yourself, how much they can get revenue from you, doesn't match that savings. They want to say, okay, if I'm going to carry the liability of $20,000, I want to be able to bill $20,000 in order to compensate it. But if they can only bill $5,000 for 2 years, and but they have to defend $25,000 in to Canada Revenue Agency, the risk return for an accounting firm is just far too great. The only time when it actually makes sense to do that is if an accounting firm specializes in the defense of just this one non-taxable benefits, and that's exactly what our firm has done. We only have non-taxable benefit filing clients. We don't have mom and pop a grocery store. We don't have a garage. We don't have this. We don't have a construction companies. Nothing. We only have independent operators and using non-taxable benefits as clients. And that means that if just one of our clients gets reversed by Canada Revenue Agency and they say, we're not allowing it, my entire accounting firm is completely gone, because that's what our entire firm is based on. So I have a vested interest in defending it, not just through the first few stages, but if need be, all the way to Supreme Court. And that's a few $100,000 to get to the Supreme Court if needed. So that is one of the reasons why, for instance, Canada Revenue Agency looks at our files and says, wait a minute, this guy's prepared to go all the way to Supreme Court. We're not interested in that fight. We'll just let him do whatever he wants to do. But the smaller guys who maybe have 20, 30, 50 truckers, and they have a whole bunch of other stuff to do, they take a look, not just look at the firm from a financial perspective, but also the personality of the accountant. Is the accountant feisty enough to actually fight all the way through the courts? Canada Revenue Agency does not want to lose in court, so generally speaking, they will not just take a look at the ability or the feistiness, but do they even have does the accounting firm have the funds to support something through the courts? It's not fair, because basically it is a system that is rigged towards, I guess, a little bit larger firms, If you specialize in something, then you can actually afford to defend it to Canada Revenue Agency. And so it's not perfect because the Income Tax Act should be applied equally, and you should have the ability to use non-taxable benefits as a policy, but they don't actually allow it as a policy unless you actually defend it, and primarily because it saves so much in taxes. That's the biggest factor. But why doesn't accountants actually use non-taxable benefits? The primary reason is they do not know. Even though I've talked to 50, 70 accountants all across Canada, there are thousands of tax preparers who complete personal income tax returns for independent operators. And realistically, independent operators in Canada, to an accountant, is low-paying freight. It's a labor-intensive, low-margin industry. If you go to an accounting firm and it's a CPA firm, and you say, I want the best, because a CPA firm is gonna actually complete my returns for me, I'll pretty much guarantee you a CPA is not going to be doing your returns. They hire somebody off of the street, pay them whatever, $20, $25 an hour to complete your income tax return, and they gain a little bit of margin from what they bill you to what they have to pay their employee. But at the absolute best, maybe the CPA looks over your income statement, but if they really trust their employee, and the employee, it's all the same thing every year, they don't even look at it. And we know that because approximately 20 to 30% of all of the CPA firmed clients that we take over their files, there are things that are on the balance sheet of those files that the CPA himself would never have authorized. Like for instance, if you're an accountant, you know what it means by your asset balancing to the Schedule 8 of the Income Tax Act. 20 to 30% don't even balance, and they should be, and that just means that an inferior individual actually completed the income tax return, and the CPA didn't look it over. Otherwise, he would have caught the error, and then it would have been fixed. But they don't look it over. Unfortunately, you are low-paying freight. It's labor-intensive, low margin. That's who you are, and they will never be able to borrow. They will never be able to bill you, $500, $800, $1,000 an hour for the work that they do. It's basically by the hour that they do it, whatever it's $60, $80 an hour that they can charge you for completing your income tax return. So you are low-paying freight. But that being said, going back to why don't accountants actually use non-taxable benefits, they don't know. They really seriously don't know, because you're a periphery. You're out of sight, out of mind. They can't charge large amounts for you. You're only on the sideline, kind of a client. And realistically, to go in there and pound your hand on their desk and say, "Hey, wait a minute, I'm a paying customer. I should do that." Well, wait a minute. You're paying him, $60, $70 an hour. Whereas, what is he going to drop the $1,000 an hour client so that he can satisfy you? I don't think you wouldn't operate a business like that. So realistically, you have to understand that you are a marginalized client. That is just who they are, and they're not putting the time in to get to know how to adequately serve the independent operator. And that's one of the reasons. The second reason why they don't use non-taxable benefits, they don't care. Realistically, you're a marginalized client. The other thing has to do with the industry itself. Independent operators have a significant turnover in the industry, and accountants are not really. They don't embrace the industry primarily because there's 5 to 10% turnover. So that means that in order to get a client coming in, well, okay, they'll do it, but they know that 5 to 10% of all of the operators that they have as clients, in 1 year's time, they're not going to be an operator anymore. They sell their truck, they get out, they go back as a T4 driver, whatever. So there's people buying and selling trucks all the time, getting into the industry, getting out of the industry. And from an accounting perspective, it is extremely costly to have that turnover. You have to have a very sophisticated onboarding system, and you have to have a very sophisticated offboarding system. And you just can't make money when there's that much turnover and you're not actually coordinated to manage the turnover. Okay, the fourth major reason why accountants don't use non-taxable benefit, it requires technology to administer, and that's really what I was talking about before. You need technology in order for it to remotely make sense. And the thing is, in order for technology to actually work, you need an ROI on your technology, a return on your investment. So if they're going to invest, say, $100,000 in technology to make the system faster and faster, are they going to get any kind of return on that investment? And the probability is zero almost that an accounting firm who doesn't specialize in non-taxable benefits for independent operators, the ROI on technology to make things better for it is there is no ROI, or very, very little ROI. And realistically, in order to automate the entire system, you need hundreds and hundreds of thousands of dollars of investment in order for it to streamline the process, everything from onboarding to offboarding to the non-taxable benefits applications of taxes all across the barrel, from the beginning right to the end. And once you have that technology, like I said, it takes probably $500,000 to $800,000 a number of years in order to build it. For us, it took we're about at the 8th year of building our technology, and realistically, we're just starting to see somewhat of an ROI on it. It's not so much that it's an high return on your investment as much as it stabilizes the profitability so that we can actually make a living without leaping from feasting to famine, feast and famine, which is pretty much the accounting industry, especially from a tax preparation perspective on there. Now, the final aspect of reason why accountants don't use non-taxable benefits, and this is a little bit embarrassing, but there's an awful lot of accountants out there who are just flat out arrogant. They believe they know it all, and they just flat out say, no, it doesn't work, and then walk away. I remember I was talking to one accountant a number of years ago, and they said, no, it doesn't work. And I said, why doesn't it work? And they said, well, there was a court case. And I said, what court case was that? Because when it comes to court case for non-taxable benefits, for the most part, I know which ones are the deal breakers and the like. And I said, so which one? He said, there was one back in whatever, at the time it was 2006. And I said, are you talking about the Don Richardson court case, which is the court case that I actually quote the court case in my first book. Exactly what I got the transcripts from the court cases exactly, and I quoted it right in my book. Are you talking about that one? And he says, yeah. And I says, I totally agree about that court case and the non-effective class action lawsuit that went through because of the origin of Don Richardson's court case. And I says, and I totally agree with the Supreme Court for not accepting it. And she looked at me and the accountant, and she realized, first of all, that I knew the court cases involved. And then she just turned around and she says, well, we don't do very many truckers anyway. And just turned around. That was her answer. Or basically, well, I know what I know. And suddenly, when she's proven wrong, she turns around and she goes, oh, well, we don't do many truckers anyway. They're not interested in you. The industry sometimes is so arrogant that they only view what they know as fact to be fact. And any other system that is out there, they have no interest in even talking to anybody about. It still goes down to a marginalized industry. The independent operator industry is a severely neglected industry in Canada. It is one of the most severely neglected industry that I know of. I don't know of any other one. Maybe, and probably not, but maybe renovations in the construction industry or something like that. People don't want to get involved in that. I think probably accountants would much rather deal with drug dealers than truck drivers. Sometimes it's not a very popular industry for the accounting firm. They only do it their way, and they're not really there to fully serve the industry and make the revolution of taxes in it that it needs to have. So those are pretty much what I want to discuss today. I know it's an awful lot, talked an awful lot really fast, but I hope it's been helpful today. And if you at all need to talk to anybody, talk to me about it some more, you can email me at r.scaper@makingyourmilescount.com, and Scaper is spelled SCHEPER. You can go online and communicate with me directly, or call us. And it's probably better to do it by email, but if you're going to call, 1-877-987-9787. And hopefully we can answer some of your questions. It is a fair leap. It is a fair bit of work moving from what a person is doing right now to the system, and it does take 2 to 6 months to change the system and change your perspective on how you deal with taxes and the like. But once you have changed, once you have moved over, it's much easier. And but it is a little bit of a leap, and we've done now almost 2,000 truck drivers moved over to the system. We are looking to do tens of thousands over the next number of years, but it really needs a solid understanding that of how to save your taxes. And if you live your life in such a way, realistically, you should not have to worry about some of the disadvantages of utilizing the system. Just as an example, for instance, loans to a bank. When you're young, it may be an issue, and you may have to really think through what you're doing it, when you're doing it, how you're doing it, and with who you're doing it. But by the time you are 50, 55, 60 plus, your need for getting loans at the bank should be going down typically, and you don't have to worry about it. If you have a few $100,000 of equity in your house, you're not going to have a problem with getting refinancing and stuff like that. It's just a matter of who. It's not a matter of if. So realistically, the older you get, actually, the easier it actually becomes utilizing non-taxable benefits and the like. So that being said, I hope you have a great day, and I hope you have a great trip. If you want to learn more ways to become a professional independent operator, subscribe to this channel. If you want to support what we do, like, share, and turn on that notification.
Thanks for stopping by Making Your Miles Count. For further Making Your Miles Count productions, call us at 877-987-9787 or download us at makingyourmilescount.com.